Well, welcome everyone, and thank you for the opportunity to speak. And I just want to encourage you today. I'm speaking on the mortality revolution and how it's impacting product and who the players are and the pretenders in almost all the venues of life insurance. I track the grids of everything you're going to see today every 30 days. So I'm a sick guy. I live on the spreadsheet. And so it doesn't matter what form of life insurance, I watch it and I write about it. And I just want to encourage you today. But before I do, I want to show you something. Some of you know that I do my charity work in prison. And the other day when I was in prison, this is some of this actual seminar that I did was probably about a year ago or so. And I was doing the old Ma and Pa Kettle mathematics. Have you seen this before? I had a actual criminal who said he deserves 75% of the actual take of the robbery because he designed the robbery. He actually hired all the people to play with him. The wheelman, the lookout man, the guy with the gun, funded it, he did everything, so he deserved 75% of the take. The other 5 deserved 25%. So I said, thinking that this would be easy for everybody to figure out, 5 into 25% means that each person of the other 5 are going to get what? 5%. Well, that's what I said, but no. A person raised their hand in the back. He came up with his leg irons, short walking to this table. He took the marker out of my hand, and this is what he said. He says, no, Steve. He said, think of it this way. How much is 5 into 1? Well, it can't go. How much is 5 into 5? 1. What's 5 subtract 25? What's 5 into 20? The brothers should get 14%. I said, that can't be right. He said, when you do math right, you should be able to prove it in different ways. Let me show you how I can prove that I'm right. I said, okay. He said 14% times 5 brothers. What's 5 times 4? 20. What's 5 times 1? 25.
Backwards and forwards.
And he said, let me show you a third time, just to show you that I've really done my skill sets here. 14, 14, 14, 14, and 14. Help me in the audience today. Ready? 4, 8, 12, 16, 20, 21, 22, 23, 24, 25. I just showed you 3 ways of stinking thinking. I know this is wrong. You know this is wrong. The pathetic thing is, about a third of the maximum security yard thought he was right. Because he proved it 3 different ways. What I'm going to do today is I'm going to expand your mind and your thinking about grids so that you don't get trapped in what I call the subtleties of the spreadsheet. Now, before I start on that, I'd kind of like to introduce you a little bit about mortality. Did you know the #1 person who's lived the longest, according to the good book? Methuselah, that's correct. And how old did he live before he died? 969 years. And what year did he die? He died the year of the flood. Not because of the flood, but he died the year of the flood. Now that was the antediluvian period. After Noah, I noticed there's a marked decline in the Bible on human longevity. And I noticed it went all the way down. At the apex of the Roman Empire, the average age for a male in civilized Rome was 25. I know, shocking. When Ponce de Leon was traipsing around the Florida Everglades looking for the fountain of youth, the average mortality during the 1500s was age 37. By the time Sir Edmund Halley came on the scene, of course, you know Sir Edmund. He's the one that actually discovered the comet, consequently named after him. But he was also the first person to actually plot an analog timeline and created the first actuarial table. And we still use what Sir Edmund did 400 years ago. We still use his basic tenets of mathematics to actually price human life on a timeline. So you know him as the astronomer, but you should really know him as the person who invented life insurance. Now, in 1694, when Sir Edmund was around, the average age of an Englishman back then was about 47. Now, we came into the first CSO that we had was 1941 CSO. We used the 1941 CSO to construct the Social Security tables. That should put a little fear of God in you. Think about it. If the 1941 has everybody dying at 62, there's nothing wrong with the Social Security system. It's the CSO that's the problem. We haven't upgraded any of this. Think about this. I just looked for the first time. Have you ever seen the Death Master list where carriers go and troll to see if their annuitants have died or their life insurance beneficiaries have died? The Death Master file for the Social Security. I mean, that if you are mind-numbing and you're in need for sleep, that is the place to go. Now, when I noticed that we upgraded to the 1958 CSO, that was the first CSO that I came into the business on. But shortly after the 1958 CSO, we graduated to the 1980. And if you've been in this business for at least 1981 on, you've been playing on the 1980 CSO. And at that time, we thought this was extraordinary. The maturity date of a contract was age 95, and we thought that was out there. We saw illustrations that went to 95. We thought that was out there. In fact, actually, back then, I'd order my illustrations that morning, and it would take them 2 hours to generate and print back in the day. Think about that. 1981, computers, clunky, big, huge boxes. Then we graduated from the 1980 CSO, and we stayed on that for, oh my goodness, a long time, to the 2001 CSO that all products now are based on, whether it's an annuity or life insurance chassis. The Society of Actuaries released 2 years ago the 2008 valuation-based tables, the VBT tables. One of the reasons why the life settlement people don't like that table is because it shows human longevity adding to the 2001 CSO anywhere between 5 and 7 years. Think of it. At the turn of the 21st century, here in Phoenix, there's a little nursing home over on 64th Street in Greenway. They had 3 tricentenarians at the time of the year 2000. So they were born in either 1898 or 99. They lived throughout the entire 1900s, and then they made it into the year 2000. The number one demographic is men and women turning 100. Although I must say, if you've ever watched Willard Scott on Sunday morning when he's saying happy birthday to centurions, most of them are women. It's like 9 to 1. Did you see the death claims at the end of the 20th century for second to die? 500 claims, less than 500 claims, all carriers, all in. Now, we males always die according to the table. If that actuary says you're going down at 79, bro, take it to the bank. You're going down. But women never obey the actuarial tables. Never. And the death claims that we thought we would have to actually pay out as a carrier, as an industry, we did not have to pay out because mother just won't die. In fact, I have a new song out right now, and if you haven't seen this, it's out on the web. I sang a couple songs at our last convention. I have a new song that I'm going to release in a couple weeks called Women Live Forever and Men Just Die, and I'm not kidding. Because, you know, when you get this anal about a subject like life insurance, I tweet on it, I blog on it, I write articles on it, I do centerpiece, I do white papers, and yes, I write songs about it. It's a sick guy. And he sings too. And I sing, yeah. So it's like listening to Elton John talk about mortality. I mean, come on, right? But think about this. This is where we've graduated on the mortality tables. When I came into the business, you were either a smoker or a non-smoker. That was it. Now we're micromanaging a Chem 24 exam and placing you on super preferred, preferred plus, preferred, standard plus, and standard. I have 5 different classifications that are being picked apart and parsed on your urine and your blood, which you probably thought your urine wasn't worth that much. Au contraire. We are now managing it in such a way where we are parsing out, and think about this. The vast majority of carriers have pushed to the 120 maturity. There's a carrier that illustrates to 131. I have 7 carriers in their contract. They don't even use age anymore. They use life of the insured. And if you saw I think it was Time or Newsweek, they had the little special that says, person that will live 150 years already born and living on the earth. I mean, can you grasp what we're talking about? The longer we stretch the timeline, what does the price tag do? It keeps coming down. I noticed a glitch that all carriers moved to the 2001 CSO, but their annuitization rate stayed at the 1980. There could be an arbitrage issue just on that alone. The shorter the timeline, the bigger the benefit, even if I'm not making 3% on my money, because the timeline is so short. And so now we're starting to look at, in fact, actually, we saw a case. Ken and I looked at a case where the case came across our desk, and I said, before we look at this, I want to see the in-force ledger. I want to see the contractual issues. This thing's got a guaranteed 3% rate of return, and the timeline is built on the 1980 CSO. There's no way. I'm not going to move this until I see those numbers. Those numbers could very possibly outperform any indexed income rider or present-day SPIA. I got to look at it. So we started to examine, how is this impacting? And in fact, think about this. And we don't do this now, but just a couple years ago, we had a carrier that was domiciled out of the Midwest. And he had two brothers that bought all their investments, savings, everything ditto. They owned the business together. And when we went to come in front of them and sell them something, they liked the part about SPIAs that they couldn't outlive. So we issued both contracts, $500,000. The brothers are born on the same day. Everything was ditto until we went to delivery. We go to delivery, and brother A is looking at his SPIA payout for life. And his other brother's looking at his, and they don't match. Now, wait a minute. They put $500,000 in each SPIA. It was for life only. They're born on the same day. Everything was exactly the same except one small anomaly. Brother A is a non-smoker. Brother B smokes. So his brother says, wait a minute, let me get this straight. My brother's getting $400 and something a month more than I because his timeline is shorter because he's a smoker. And I said, that's right. And he goes, so now we reward bad behavior. Can you imagine people going out slapping a nicotine patch on their shoulder, right, to get the coatine bleed off in their urine so that they can qualify as a smoker so their annuitization rate on life-only contracts is higher? I mean, I know interest rates are suppressed right now, but that would be a dodge. Can you believe this is where we're going? And this is why I'm trying to get you to see it affects everything we do. When I go on a grid and I look at the grid work that we look at, I have to tell you, it's amazing because you'll see people that are number 1, 2, and 3 on the grid, and you'll never see them on mine. And they always complain. I get hate mail from about 4 or 5 carriers. How come, Steve, you're not showing our carriers on the spreadsheet? And I said, very easy to understand. Because every time I see you, you take the first position on super preferred, preferred plus, and preferred, and I can never get it issued. And I've seen it now for 30 years, and I'm knocking you off the grid. Because it's only an advertisement for the spreadsheet. It has no intention of ever becoming truth on the application. Now think about this. We have people out there, I couldn't buy a super preferred from this company. Then I have 2 banks out there doing the same thing. They price on the grid. You can look at Vital Signs, Vital Term, Vital UL. You can go on CompuServe, right, CompuLife. All these will show you what I'm talking about, and you'll say, oh my gosh, they're number 1 and 2. I can never get it through underwriting. I already know going in that that number is not going to be true, and I tell the agent because he wants to sell the number 1. Now, when I'm looking at contracts too, I also say this. Think about this now. We went down this line. The spread between preferred and standard. How many have heard of a table A in the last 20 years as a rating? Nobody does that. So the spread now is all the way down to table B from preferred, and certain carriers have positioned themselves, and because I have our sponsor here today, LGA, or Banner, I have to get used to saying Banner. When you see standard plus, the carriers that hang in there and underwrite are actually underwriting off standard plus their mortality, and so the table rating, even if they did table B, C, or D, they're still going to be beating everybody else because they're placing their numbers on their standard plus mortality, not on the standard mortality. Only a few carriers do that. LGA is one of them. So you have to be concerned. You say, oh, but they're winning. They have a better rating. I never look at the rating anymore. I have to look at the all-in premium. I could be looking at a table B from one company, right, at standard, or I could be looking at Banner at table C, right? But their numbers are going to be better because my mortality chassis already is cheaper on the get-go. Before I even hit underwriting, I know the plus is going to be there. Do you see what I'm saying? So I can't depend on grids anymore because I can't get the underwriting, right? I'm not going to get the underwriting from the top 3 or 4 guys. I think it's an advertisement. I call it vapor on paper. Because I know going in, they're not taking offers are so high. Think about that. Declined, or the client sends it back. I'm not going to take it. Because they asked for this. And by the way, when you see the grid work that's out on the websites today, think about this. Almost 40% of everybody trying to buy life insurance off the grid on an internet site doesn't take the offer because everybody thinks they're super preferred. How much has mortality hit our scene? Think of it this way. A female, 25, $100,000 coverage, 10-year term. The $75 policy fee is greater than her annual premium. Do you hear what I just said? And there's only a handful of carriers that actually give you commission on the policy fee. So here I'm sitting at a female, super preferred, $100,000 of coverage on a 10-year term. Her policy fee is greater than her annual premium. When I came into the business, the threshold was at $50,000. By the time we got to 1987, they pushed it to $100,000. You're going to start seeing we're going to have to go up higher. We're just not getting the death claims at this level. When you think about it, remember the old adage, 2% of all term ends in a claim? It's actually 0.5% for the last decade. Think about what I just said. And now we went from, I thought, when I came into term, I thought you just bought ART back in the day, 30 years ago.
I think that'll change, though.
Hopefully.
Hopefully. Claims on term.
Hopefully.
Because you've got now all this 20-year level term out there.
All right.
And I think you're finding that the lapse ratios are lower.
They are definitely lower. Let me tell you this. We now went from, when we went to 20-year guaranteed level, I thought that was amazing. At the year 2000, when we went through the XXX and Triple E, I was interviewed by the Wall Street Journal. They said, Steve, is it going to be a bump in the road or is it going to be Armageddon? I remember everybody from every home office told me, get ready for rate hikes. And it was down 12% 2 years after we turned 2000. And it's been decreasing ever since. And we now have 3 carriers that do 40-year level term. Not UL. Term. True term. So now we're in the guaranteed level term and guaranteed universal life. And here's a new twist. I now have 8 carriers that are IUL carriers as well as GUL carriers. And for 10 to 15% more than their GUL premium, you can spend a little bit more on their IUL and they guarantee it to 120. Do you see where we're going on this? When you think about the premium commitments that are happening, and remember, many people are bailing out on guaranteed UL just because the pricing is so unbelievable at low interest rates. They just can't handle it. They're carriers. They're leaving. They're just leaving. But think about this. Who's joining the market? Here's the shocker that I saw 4 days ago, right? We did a big wire feed off the Prudential. The Prudential just rolled out their new IUL. Here's Steve, because they keep everything, right? Here's everything. I'm reading all the anti-IUL stuff these guys put out to their proprietary field force, telling them how bad it was and how terrible, and Prue will never be caught dead making it. But they made it. I saw Hancock's roll out, what, 6 months ago, 7 months ago? But they did it. This reminds me of the old days when I saw the mighty company somewhere domiciled out of Milwaukee who said, you'll never see a VUL out of our city, if you know what I mean. And I'm just saying, but they did it. But they did it. When I see Prue and Hancock enter the index market, that's a tip-off. That's a tip-off. The big blue chips are not far behind. Just think about it. That's how much play it's getting. By the way, I did an article called Life Insurance Proposals, Vapor on Paper. I got to tell you, the whole life community just threw up all over it, right? I got unbelievable hate mail. I just cannot believe these guys were only talking about insurance. I don't want you to take my life. And remember, I work in prison, and everybody that comes to chapel isn't necessarily converted. So if you mess with me, you know what you got to pay for. When I'm looking at the numbers right now, we did 2 tests. We did the Lincoln Financial Advisors test on the Monte Carlo, which I thought was excellent. If you haven't seen this, it's a great piece by Lincoln. That piece shows the Monte Carlo at the lowest level of any 20-year tranche, 40 years back. That's 280-something quarters. And the worst scenario was 5.5. I went back to the S&P. The S&P was higher at 585, but it was with dividends. And there was no S&P 500 in 1928. It was the S&P 90. So I took the lower position of 5.5. Here's how I illustrate now. I always show the carrier's 30-year look back. I didn't say I believe it, I just show it. I also show the 5.5 bottom end. And I use the caveat that Lincoln put out because it's a great piece. If you don't have it and you're selling IUL, you should get that from Lincoln. It's excellent. I have it. I'm sure Adam has it. You can get that. We just talked 3 carriers into doing what's called a middle quote. So why? Because IUL was constructed to play 200 basis points above the current interest rate market. So if the best interest that's out there now, the best one I just saw on the street yesterday was 5 flat, I should be around 7% in the middle, quoting, because that's what it was originally designed to do. It wasn't designed to do 12, 14. It's designed to be 200 basis points over current interest rates in that year. That's what it's designed. Now, I'm not saying we wouldn't get more. I'm just saying that's what it was designed for. If I could do a 3-quote system on IUL, I'd be doing that all day long, showing the 5.5, which is historicity and provable. I'd be showing the mechanics of why they chose 200 basis points. I'd be putting that number in. And then if they want to still carry on and put their 30-year or 20-year look back, I have no problem. Go ahead and do it. But this is what we're looking at now. We're looking at mechanics, longhand. I'm thinking of this. I noticed that if I'm looking at my own mortality and I'm looking at my numbers, and then I take my wife who's only 1 year younger than I am, I can already expect and tell her you're going to be living without me for 12 years, and she already started celebrating the moment it came out of my mouth. But think of this. My girls that are all in their late 20s and early 30s are going to see age 100 if everything stays static. I didn't say advances. I said static. Can you imagine sometime next year you're going to see the first carrier that issues at age 95? Issues. Issues. Not maturity date, issues. I think I'm going to live to see the day. I didn't think we'd ever see it. I used to think the maturity date 95, 30 years ago, that was long. Now we're talking about issue. Second to die, on a second to die platform, where the first insured can be 95 and the second one, as long as it's not a spread of greater than 10, you can put them both on the chassis. We're looking at that right now. Think about this as a wow factor. Right now we're looking at variable universal life, which has really been sucking the wind for the last, I'd say, easily 6 years. However, they found a way to do what I would call a hedge position on a VUL, which could guarantee principal. If that comes out, it's going to give indexed universal life a major run for the money for the boys who are registered in FINRA. If that gets put on the street in the next 24 to 36 months, which I think you're going to see the first one come out, you're going to see guaranteed flat with no caps. So when you think about, oh, I have to figure out the spreads, the caps, right? Participation rates, that's all off the table now. It's going to be no caps, hedge position, principal preservation on a VUL. Now you're going to have to be FINRA licensed to play that game. But there's another alternative. That's what we're seeing coming on the scene right now. That's why I said, wow. Think of it this way. We just ran numbers. How pathetic is SPIA rates right now? Pathetic. But the mortality credits still beat, think about what I'm saying, still beat any indexed rider on indexed annuities or indexed life. Still beats it. Now, fair enough, no liquidity, no asset, you spent it. But if you were looking for raw income, even at these pathetic rates, the mortality credits in an SPIA can still make up for it. And oh my goodness, it beats anything we have on the market. Proviso, that you're willing to give up that asset and just take income for the rest of your life. Now you think about this. The companies that wrote on the 1980 expected all women to go down at age 90. I want you to keep that in your mind. Then go to the same nursing home that I quoted over at 64th and Greenway. And look at all the gals over there that are in their 90s. They're taking it to the bank. Every day after 90, the carriers are cursing their names. They don't know which one. What happens when you're the carrier for the LTC and you're the carrier for the SPIA? You don't know if you want her to live or die. You're getting killed either way. This is where we're going. I just want to introduce you to 21st century thinking, mortality on a timeline, and I'm talking about under static conditions, not under advancements. Did you see, as an idea on the news about 30 days ago, they were doing the, I think it's the, what's the gastro, when they're trying to, they put a belt, what's it called? It's some kind of a belt tightening issue for people who are struggling with great obesity. Lap band, thank you so much. And the lap band. And out of this, something happened that they did not expect. Several people that were type 2 adult onset diabetes, all of a sudden their diabetes was cured. Something in that technology, that surgery, triggered hormones in such a way that they now are not diabetics. Now, they don't know that's going to be true for everybody. They just said that was an accident. Everything I'm talking is based on static data. What happens when we start to move into these realms? I can't remember the last time we deep sixed anybody and you declined a guy for simple cardiovascular anything. I mean, think about it. Might be rated, but declined male cardiovascular. And here's the best part. You know the whole women's rights movement? Fantastic, right? Think about this. Now our generation of baby boomers have been in the same workforce, work pressure, work stress that we males have been in. Welcome to our world. Now you get to enjoy cardiovascular disease just like we do. Everything just becomes equal. Isn't it surprising, only 4 of the last 5 years, we are alarmed by female cardiovascular problems and heart attacks, as if, oh, this is news. Well, it is news because we never experienced it before. But workplace stress that males enjoy is the same stress on the same anatomy for females. So now all of a sudden, we're looking at whole new areas. Here's another thing too, think about this. We are now starting to discount family history. I cannot believe in the old days, we used to say family history is everything. If your mom and dad had cancer, we're going to ding you just because you're in their bloodline. But now, everything is changing so fast that family history is not the weight on the actual debit and credit of an underwriting balance sheet anymore. So when I look at the new technology and everything that's happening in disease, when you think about it, it's huge. And the impact is so great that when you see the new repricing on product, and it's going to go beyond just term and permanent. Think of this. Right now, when I came into the business, and I compare it to right now, second to die in the 1990s to guarantee the premium for a male and a female, age 65, non-smoker and preferred, was 26 grand. That was the best. Today, I can get that same coverage to 120, 20 years beyond what I just had back then in the day in 1990. That number is under 10 G's. So what has happened in the last 20 to 30 years that would cause such a decline? That we're expanding second to die. And now we're talking about, instead of 3 generations on dynasty trusts, we're now talking 4 generations. Can you imagine the first couple carriers that are now coming out with no age limits on second to die? Grandfather could be 70, his new grandson could be 2. They fully fund the second to die while grandfather's living. The moment he dies, right, the child stays online, and that child's expectation, life expectancy, is age 100. 100 years of tax-free income based on a platform that we wrote back now that he might enjoy in the 22nd century. Tax code remaining the same and so forth. This is the mortality revolution on steroids, and it impacts the way we do product, and it impacts the way we do pricing, and it totally changes the grid. In my presentation, I don't know how much time I got. I just want to make sure, what's my... Oh, well, I thank you so much for that. However, not all of us can enjoy that. Okay. In our grids, I show term at 5, 10, 15, 25, and 30 for all carriers all in. All GUL, but let me say something that I also want to point out to grids that I think would really help you. I noticed the other day when I went to get the Guaranteed Universal Life grid, and I asked for all carriers in the United States, and it gave it to me, I noticed an anomaly that started to bother me. I'm asking you just to be the person, be the mathematician. I saw age 90, 95, and 100. And I'm looking at the age 95 rates on a GUL, wondering why it is there for a preferred, super preferred. Can you imagine dialing back the death benefit in the light of the greatest mortality revolution when nobody's giving the death, we're not experiencing death claims, and you're showing 90 as the end game for a super preferred? I'm just trying to help you. The grid shows the 90, everybody that's age 90 as number one. And I say if he's super preferred, that's not a good grid. This guy's going to blow by the tables at 90, and we're talking about maturing or ending or endowing the contract at age 90. So anytime I see preferred, super preferred, or preferred plus, and I take every one of those guys off the grid. 90 goes off. 85, 90, 95, I completely wipe them off the grid. Because I know the odds are they're going to blow by those numbers, and that's just a cheap way to get the premium under the door and have the client sign off on it, and I can't do that because the math doesn't work. And if you don't believe that, go to the Society of Actuaries 2008 VBT tables. When you see the relative risk tables on that chart, and you match that up to what's going on, you can never sell short the endowment date, especially, by the way, especially if you're selling income scenarios. Is anybody in this room, I do this big time, supplemental income with life insurance? Well, heads up, I'm sorry to bring this up to you, but you definitely want the maturity date to go way past 90. Would you not agree? Many years ago, I wrote one of my first columns in Broker's World. It was about policy loans and their prices. And I got a call from an attorney, said, I'd like you to look at and review an in-force ledger that goes for my client who's 94. I said, really? I couldn't believe the guy was alive. This was back in the day. So I saw the in-force ledger was on whole life, participating, and direct recognition loans. I reviewed it, and I called the man back, and I said, the maturity date of the contract ends at age 95. And he says, well, can you 1035 it? Well, actually, at that time, I don't have anything to 1035 it to. Back then. Today I do, but not then. So I said, I don't know what to do. I will tell you. He says, well, what's going to happen when he matures? I said, well, he's going to pay taxable event on all the policy loans that he took out, and I hate to tell you this because I don't know how to bring this up to you, but I just looked at your in-force ledger, and your client never paid the interest on this. Is that so? And he goes, well, yeah, they just took it out of the contract. So the cash values cannibalize themselves to pay the annual interest. So not only do you have a $694 ordinary income tax bill for the policy loans that you took on, but all that money on the inside that you took cannibalizing loans on, that's phantom income. And if he lives another 7 months, if he's not dead by then, he'll want to be. Because that bill is not only what he took constructive receipt on, but it's also the bill that's in the contract because he never paid the interest. So it cannibalized the cash values and kept accumulating over all those years, and he's got a secondary bill. So when I talk about doing supplemental income and I talk about endowment or maturity dates, how important is this? This is important. I do not want the client to have the end game happen while he's still alive. It's an ordinary income tax, so that's an issue, and it's a big issue. And that's why I say maturity dates, endowment dates, times that you're plotting, and here's another thing that we just started speaking to the security side. Think about this. This will be good for us. In the last 10 years, I have never done a planning scenario, and I don't care if it's estate planning, I don't care if it's retirement modeling, I don't care if it's business succession planning. I have never done anything. Even if I wasn't going to use life insurance, I always have the client on the first interview fill out a Part 2 medical. Why do I do that? Because I don't know what the plan's going to be like until I plot the mortality. I do that before we talk about mutual funds, limited partnerships, whatever we're going to sell, stocks, bonds, I really don't care. Whatever model I'm using, whether it's estate planning, retirement planning, business succession planning, whether it's qualified or not, I need to know how long this guy's going to live. And so as a part of first contact protocol with a client, we fill out a Part 2, even if we're not going to do insurance, because I still have to plot the line. When the client's asking me why we're doing this, and I tell them, nobody objects to this. I'm going to be taking family history. I'm going to have them answer the same questions. I'm going to go out based on what I've seen and try to plot what I think is a reasonable timeline for dad, which I know, of course, he's going down one side, 1 year either side of the actuarial tables. But mom, she cheats, so whatever she tells me, I'm probably going to add 5. I've noticed a new revelation too. This is disturbing. I noticed the average age in America for first marriages, the spread is 3 years. I'm just saying strictly from a planning point of view, 3 years. I've noticed the second marriage is 9. Third marriage in the teens. I think when you walk into a relationship like this and you're 13 years spread, you need to tell her basically if all things were equal, and they're not, because she's 13 years younger than you, she's going to be a widow for 20 years. I mean, just heads up. You're going to be alone. So if you're okay with that, the spread, the wider it gets. I'm looking at timelines because the male, we're pretty predictable, but gals are not. So when I look at a measurement of what's going on, I want to make sure that I understand it. So I do a part 2, and I weigh everything out by the basis of how I plot my timeline. And once I've done dad and mom, I'm ready now to look at the retirement modeling or the estate modeling or the business succession modeling, but not until I see that first. Almost always, the part 2 leads into a discussion on life insurance, even though that was not my original intention, but it's a natural segue into it. And by the way, I just want to ask a question. Did you see LIMRA's first quarter stats on life sales? It just came out over the wire about 3 weeks ago. Interesting, interesting. Overall, we've had a slight increase in life insurance. What is the demographic that's pulling this? Because you'll be surprised as much as I was. 65 and over. That's what's saving us right now. Do you realize it's the geriatric community that should have been buying permanent life insurance all along, decided to buy term and invest the difference, which they bought term and spent the difference, and now they have at the very minimum, I have final expense to pay, medical issues like that, so it should have been permanent all day long. Now, all the money that's being made by most agents is in geriatric land selling life insurance to people who should have bought it when they were young, but they were told by their CPA or some wacko out on the internet or somebody on MSNBC who remained nameless because I'm tired of getting hate mail, that you have to understand, buying term, it's not going to work. I have permanent obligations. And by the way, let me go one step further than that. When we teach basic entry life insurance to a newbie, I use this word, is it a term or a perm scenario? Is it temporary expense reimbursement money or is it a permanent expense reimbursement money? Is my obligation, whether tax, bills, mortgage, whatever, how long is my permanent obligation? If I have a permanent obligation, I wouldn't fund it with my mutual fund or retirement scenario when I can get leveraged, discounted dollars with life insurance and the tax advantages that go along with it. So anytime I look at a timeline, I'm looking at, is it a temporary expense issue or is it a permanent expense issue? I never talk about life insurance until I figure that issue out. So this issue, obligation, this financial liability will be for the rest of your life. Well, that's got to go perm. And I'd rather buy it now than buy it later. I'm walking up to a gentleman, we just did his case, $10 million. 70 years old. Here's his story. He says, I was approached when I was 43. I already had about a $5-6 million problem. Now I have a $10 million problem. I told him I was going to self-insure by buying term and invest the difference. That story I've heard time and again. The premium is 6 times what it would have been if he would have picked it up in his 40s. Even if he would have replaced it twice with new product lines, he would have been ahead of the game by almost 20 grand a year. That's the impact of the timeline. Now think about this. The price tag for a 60-year-old is the same as it was for a 40-year-old, right? Back in the day. Think about that comparison. You say, wow, Steve, it's really come down. Even 60-year-olds are priced pretty well on the grid right now. Yes, because of our longevity, we keep pushing the timeline forward. So every time I see that impact, it impacts our grids, our spreadsheets. And that's why I look at things like that, because I want to measure it. And the reason I bring it up is because it's important not only to measure it, but am I buying the right product? And as I've said before, I'm going to look at underwriting. Is the carrier going to give me super preferred even if they're number one on the grid? Are they going to be accommodating in the way their price contracts are? Will they let me convert the term? And that's another reason why I toss carriers off the grid. If they have no product to convert to and I have a permanent scenario, why am I buying term? Especially with a carrier that doesn't have a conversion product. See, does that make sense to you? See, it doesn't make sense to me, and that's why I always want to look at mortality. So when you walk out of here, if you heard anything today, I want you to choose and select your best life insurance part 2 and have several copies in your briefcase from now on. Because you're always going to do the information on their longevity first, even if you're a security person. I mean, listen, I'm in front of broker-dealers talking like this. Even if you don't want to use life insurance, even if it's anathema to have a guy like me up here in front of you. I'm telling you, I want a part 2 out of you because I don't see how you can plot estate planning, retirement modeling, or any kind of business succession planning unless you know what the math is on how long they're going to live and when am I going to need this money and when is it going to transfer, when's the charity going to get their death claim. I need to know that. And I can give a reasonable understanding, especially using the Society of Actuaries 2008 VBT tables. It's going to get me in the game. Does that sound reasonable to you? This is a brand new way to approach planning using a medical app as your front-end opener because you're going to tell your client, I'm doing this to plot your life expectancy so that I can model close to what I think is going to happen. Now, of course, I told you I pad 5 years on every female I quote just because you're unpredictable. I just don't think you obey the actuarial science any longer. But I all want to give you encouragement. I've seen the certain grids, and certain carriers are big players. In the term market, I mean, you're seeing some of the biggest players right now. Banner's huge. AXA's big. ING's huge. I look at them all the time. I'm not talking about once in a while. These are people that show up on the grid. When I'm looking at Second to Die, right now Mother Met is becoming a big player. Shockingly, Lincoln Benefit, which really shocks me. Some of these carriers are now coming to the task. The people that own the single deposit, Aviva, North American on GUL. And remember, as I said before, some IUL carriers are now adding just a little bit more premium and they can match their GUL counterparts. That happens the same on Second to Die. So it's very important to start thinking, I need to start pricing everything out of my grid. And here's the last thing, and I'll finish with this. I am a premium purist by heart. I don't like homogenizing mortality and morbidity together. So one of the two is going to suffer. If I'm trying to buy life insurance indemnification and I'm trying to do supplemental income on the same chassis, something will suffer. So I always do income by itself, suppress the death benefit down to the DEFRA, and TAMRA quarters as low as I can get it. And if I need any additional insurance to make up the difference, I buy a separate contract, whether it's term or perm. Every time you mix tactical issues of income and indemnification, one of those two is going to suffer. When you add morbidity products like LTC, accelerated riders, catastrophic, illness, the moment you put those on, you're doing the same thing. I'm not saying you shouldn't do it. I'm just saying something's going to suffer. They weren't built to coexist like this. And so it's a pricing issue. You'll notice that, wow, how can these carriers do so much better? Because they don't put that stuff on. They don't add additional policy provisions that cost the contract and erode the mortality chassis' best shot at pricing for death benefit on death benefit, dollar for dollar. Does that make sense? I'm not saying that is the way, but everything we've seen thus far has shown us time and again that when you mix tactical issues of indemnification and income, something suffers. Since I am a purist, I like to separate the planning issues and match them up with tactics. Does that help? I'll take any questions. How much time do we have, Brad? Yes.